Welcome to the Financial Foundations podcast, your gateway to the fascinating realm of finance, brought to you by Base Wealth Management. In this show, we delve deep into the world of money, guided by seasoned experts who will unravel the complexities of finance and provide you with invaluable insights and practical advice. Now, here are your hosts, Dustin Taylor and Alex Wolf.
Welcome back to the Financial Foundations podcast, brought to you by Base Wealth Management, where we are the foundation to your financial plan. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolf, certified financial planner.
And for today's podcast episode, we had a listener reach out, Thomas from Sarasota. He's 71 years old, and he said, I'm reaching RMD age. What are some things to consider, and how does it impact my plan and income? We're just going to dive right in. Alex, can you please first give a brief explanation of what RMDs are and why they are a crucial aspect of retirement planning?
So an RMD stands for Required Minimum Distribution. And that is an age at which you have to start taking mandatory withdrawals from qualified retirement accounts, things like 401ks, IRAs, 403bs, etc., but not from a Roth IRA. Those are excluded unless you inherited the Roth IRA, in which you will have to take out money from that. But what's important is planning for that income once you reach RMD age. And at the present time, RMD age is the year you turn 73. Now, due to some changes in the tax laws, that's going to go up to 75 in 2032. So keep in mind, as of today, it's 73, but we'll be going up to 75 in the future. So you want to prepare yourself. If you're not already withdrawing from those retirement accounts, there will come an age in which you are required to, or if you're not withdrawing enough, and we'll talk about how it's calculated, you may have to either start withdrawing more or even think about other strategies with that income and how it's taxed.
So yeah, we're going to just continue on, and we're going to go over some various aspects of RMDs, including some IRS regulations, as you mentioned, inherited IRAs, spousal considerations, and strategic planning. So first up, how do RMDs fit into the broader retirement planning picture?
So when you think about how much money you've saved or contributed into your 401ks and IRAs, that will help predict how much income at RMD age you're going to have to start withdrawing from those accounts, because they are taxed at income tax rates. So from a tax perspective, you want to start being proactive, and you may want to start considering things now like Roth conversions, which we've gone over in a previous episode, and why converting it may make sense to reduce future RMDs. But from a plan standpoint, you're going to need to think about how that income is going to affect you from a planning standpoint in tax considerations.
Okay, and so what factors does the IRS consider in calculating RMDs, and how can people plan for these calculations?
So there's nothing that you really need to do. You obviously want to work with a planner, but from an IRS standpoint, they calculate it based off of a uniform life expectancy table and how big or how large your retirement account is. And they calculated it on December 31st of the previous year. So if you turned 73 in 2023, they took your December 31st, 2022 value of your retirement accounts, divided it by that life expectancy number that the IRS comes up with. It's like a mortality table or something like that, and gives you a number and how much you must withdraw. The good thing is you don't necessarily have to take out that much from every single account. You can combine it and take it out of one of your retirement accounts.
Now that we know how the IRS calculates RMDs, let's explore some different RMD rules that they've come up with and some nuances with inherited IRAs, as you mentioned earlier. So how do the RMD rules differ based on the date of that inheritance? And what are the implications for beneficiaries?
So there's a couple of rules to think about. One is if you're a spouse that inherited the IRA versus a non-spouse. We'll start with the non-spouse. It's a little bit more straightforward. So there were some recent legislation changes a couple of years ago that changed the way in which you must withdraw from inherited IRAs if you inherited that money from a non-spouse. You now have 10 years to deplete that entire account. So what that means is you don't have to take out a specific amount every year. You can think about how, from a tax standpoint, you want to start withdrawing that money. So if you're in a low tax bracket right now, but maybe in a couple of years you're going to be earning more or going back to work, you may be in a higher bracket, so you want to withdraw more now on the lower bracket versus later. Or you could just split that up and take out however much money it is over 10 years. So every year you take out, 1/10 of that until it's depleted. So that's pretty much the main point of a non-spouse inheriting an IRA, the 10-year rule. And mind you, if you inherited a traditional IRA, that money is going to be taxed at your income tax bracket. Where if you inherit a Roth IRA and that money's already been taxed, you basically just take it out over 10 years and you don't have to pay any taxes on it. So there's not a lot of strategizing for inheriting a Roth. You should thank the person you inherited it from for paying the taxes for you.
And so let's move on to the spouse inheriting IRAs. What are the considerations when deciding whether to roll the account into the surviving spouse IRA or keep it as an inherited IRA?
Yeah, so this is where you have a little more leeway in planning that you can do. I would say the most common thing is that you basically move that into your own IRA and accept it as your own, and then you can deplete it at your leisurely or whenever you reach RMD age. You don't have to follow the 10-year rule if you move it into your IRA, which you're allowed to do if you're a spouse. The other two options are, one, deplete it over 10 years, or two, if you're the surviving spouse and the spouse that passed away was younger than you, like by a decent margin, you may want to move that into an inherited IRA, and you can still follow the old rules and deplete that once that person would have hit RMD age. So you're deferring the future taxation of that by taking it over their lifetime instead of yours. So if they were significantly younger than you, you may not want to move that into yours because you're going to have to take an RMD on that sooner rather than later, and instead move it to an inherited IRA and take the distributions based off of the person who passed away's life expectancy once they hit RMD age.
So just like with everything in retirement, you need to have a plan. So how does RMDs affect taxable income, and are there some strategies to alleviate that tax burden?
There are. So when you think about RMDs, in most cases, unless it's a Roth, it's taxable income. So it's taxed at your tax bracket, your income tax level bracket, and not long-term capital gains rates. So when you think about strategies, if you don't need that money, which some people don't, is the reality where most people do need that money. So they're taking that RMD regardless, and they're pocketing every dollar of it. But if you're in a fortunate situation where you already have your income needs covered, one strategy is to do a qualified charitable donation, where you say your RMD is $50,000. You take as much of it as you need, and that's taxed, and then donate whatever you don't need to a charity. So if you need 25, you pay income tax on 25, and then you can donate the rest of your RMD to a qualified charity. Where this rule kind of ends is at $100,000. You can donate up to $100,000 in a year to a qualified charity. So if your RMD is $125,000, you can only donate $100,000 of that to a charity, and you're going to take the $25,000 and pay taxes on it.
And speaking of QCDs, how should people factor RMDs into their broader legacy planning and charitable giving goals?
Utilizing QCDs properly is a great tax strategy. So what a lot of people do is they'll write, if they're charitably inclined speaking, they will write like a check from their checking account to the charity, church, or whoever. And that's how they give their charitable donations. But once you reach RMD age, you should not do that. the correct tax strategy is to do it from your IRA, because that will reduce your tax liability. If you're going to have to take that money anyway, don't take it out of your checking, take it out of your retirement account. When you think about legacy, is an interesting question. Obviously, with your financial planner, you want to review your estate plan and have the proper beneficiaries set up. An easy way to gift a charity is after death, where you designate a charity to be a percentage beneficiary of your IRA, whoever you want to designate, which charities can be one of those. And that could be one way to leave a legacy. But when you factor in, if you're trying to leave a beneficiary money, once you start taking and depleting an IRA, you're going to have to rethink how you leave a beneficiary money, because they're going to inherit whatever's left, which, depending on how long you live, you're going to deplete that IRA every year until you pass away. And then whatever's left is left to whoever you designate as your beneficiary. And once they inherit that money, they're going to have to pay taxes when they start taking that money out over that 10-year rule, which we talked about with inherited IRAs. Some people would rather pay the taxes themselves versus having to have their beneficiaries pay the taxes. So they may start thinking about converting to a Roth IRA, but in order to do so, you have to satisfy your required distribution first before you convert any additional money into a Roth IRA. But then once that beneficiary inherits the Roth IRA, that money, as I mentioned earlier, is not taxable to the beneficiary.
So we probably sound like a broken record at this point, but as with anything in retirement, you want to have a plan and talk to a financial professional about your specific situation and the future implications of your RMD. Thanks again to Thomas for that question. And if you'd like any more insights or information, you can always check out our website at basewealthmanagement.com. Subscribe to our YouTube channel.
As always, if you have any questions, you can email those to us at question@basewealthmanagement.com. And please subscribe to the podcast on your favorite podcast listening app.
I'm Dustin Taylor.
I'm Alex Wolf.
And happy listening.
We hope the expertise shared by our hosts, Dustin Taylor and Alex Wolf, has left you feeling empowered and informed. If you're eager for more financial wisdom, don't forget to subscribe, rate, and share the show with your friends, family, and colleagues. Until next time, stay sharp in the world of finance.